The other day, I asked the investing subreddit what they would do if they just magically received $2.5 million, and we got some insane answers, but we also got some really good answers. So what I'm gonna do today is go over some of my favorites from the perspective of someone with a degree in finance, and then I'm going to give you my answer. And that answer is not going to be for someone with a degree in finance or someone who understands things like fundamental analysis. It'll be the answer for the average person, because most people don't have $2.5 million to throw around, but most people do want to start investing or want to better manage their investments so they can retire comfortably. Now, why did I pick $2.5 million? Well, because in a recent study, it said that the average American across the country said that $2.5 million was the net worth that they would need to feel wealthy. Now, obviously, if you live in like San Francisco or Los Angeles or New York, you'd probably need significantly more, but this is a good baseline for the country. So with that said, and without further ado, let's go over some of Reddit's answers. All right, the first one, out of nowhere, hire professional financial help. This is a great place to start because if you just come into a large sum of money like that, that's probably exactly what you should do. Now, yes, you can manage it yourself, but in reality, when you come into such a large amount of money like that, the best thing that you can do is get qualified help from a financial planner or financial advisor. Just make sure that they don't see dollar signs written all over you now that you've come into money. But if you can find a good quality financial advisor, a financial planner, that is probably the greatest first step that someone can take. Next one, LOL, depends on your age, but I would personally put 100% of it into VTI or VOO and plan to hold it for 30 plus years. At 10% return, 2.5 million would turn into over 43 million. Now, I relate to this a lot because I love VOO. VOO is basically an ETF that tracks the S&P 500, which is the largest 500 companies in the United States stock market. Now, VTI is similar, but the major distinction is that VTI is the total US stock market ETF. So it tracks all of the stock market regardless of size, where the VOO tracks the top 500. They both give you great diversification. The only difference is VTI will be a little bit more exposed to some of those smaller cap stocks, which may turn out to actually be winners in the future. Whereas VOO is recalculated on a quarterly basis. So as those small cap stocks grow, they might push out some of the larger stocks in the VOO, but they might already be of a size where you missed out on some of that initial growth. But overall, I do like this one. I think this is pretty solid advice. All right, next one, put it in JEPI and retire in Argentina. So this one's interesting because JEPI is an ETF, but unlike VOO or VTI, this is more a dividend play. So this one returns quite a high dividend. It's about 8% last time I checked, but you have to understand that you're basically getting a dividend. And I don't want to say nothing else, but when you look at its historical performance, it stayed relatively flat. With that said, doing some quick maths, that's 8, 16, that's like $200,000 per year on a dividend if you invest your total $2.5 million in just that single ETF. For me, that's a little bit not diversified enough, but at the same time, it is an ETF, and overall, I would say this is mid-tier advice. Personally, I would like to see a little bit more diversification. All right, next one, long one. Buy BTC Bitcoin with 300 grand, and then the S&P 500, the VOO, which I do like, for $1.5 million. Buy every week at $150,000 over 10 weeks. Basically, that's known as dollar cost averaging. I'll talk about that here in a second. I'm not trying to time the market. And then buy QQQ, which is similar, but it tracks the NASDAQ 100, which is tech heavy. So it's similar to like VGT, which is a tech heavy ETF. He would do $750,000 for that over 10 weeks, again, to dollar cost average. I don't have any real problem with this. I do like the idea of dollar cost averaging. Basically what this is, it's usually used when the markets tend to move downwards. So before or during a recession, you dollar cost average in as time progresses to get a better cost and not to invest all your capital and then miss 10 or 20% more downside. With this said, there are some studies that say if you get a lump sum and you're going to invest it, a lot of the times, instead of trying to spread it out, when you look long-term, 20, 30 years into the future, it actually tends to work out better in most scenarios to just invest the lump sum immediately. And why is that? Because of the famous saying, don't time the market, it's about time in the market. But I'm cool with dollar cost averaging. I think it has its place. All right, now followed by a short one, buy land. I asked where at, and they said depends on your preference. Me personally, some remote land in Vermont, New Hampshire, or Maine. So the thing about land, obviously this is a finance channel, so I always relate it to investing. Land can be a tricky investment because it really depends on the infrastructure around you, and it depends if you can kind of almost predict where infrastructure will follow. But land as a total investment play, a lot of the times you're really protecting yourself against inflation, and you're kind of buying something that is tangible, and perhaps you use the land for your future. Maybe you build a house, etc. But when it comes to an investment with such a large sum of money like $2.5 million, I think there are better avenues. And better avenues even in real estate. You could buy rental property, you could buy already single family residences, etc., etc. All right, next one. ETF would be the handoff option for investing. And this is very true. ETFs just mean exchange traded funds. They're kind of like a mutual fund, but they are exchange traded. You can trade over an exchange. A lot of times they have very low expense ratios and very low or non-existent fees, and they make a great option for the average investor. The average investor should absolutely have ETFs. I don't want to go too deep into that, but I'll talk more about it when I give you my answer. All right, next one. Duck my head a lot. 2M is already too tall. Very funny. 2M, 2 meters. All right, next one, a real one. I would put some money in apartments for rental, probably one of the best ways for passive income. While I love real estate, and I do agree with this, and I think you can do very well with rental properties, both single family and multifamily, I wouldn't necessarily say it's passive. In fact, I would say it's not passive at all. You can hire a property management company, but you're still going to be actively involved to some degree. A lot of people think that real estate is the ultimate form of passive investing. I would argue that, in fact, it's probably actually the stock market, buying like a REIT or buying an ETF and just letting your money compound on itself. Real estate is awesome. I love it, but I wouldn't call it passive. All right, next one. We have a complete breakdown of a potential portfolio. So 40% S&P 500, that would be something like the VOO. 20% whole world index. So that would be something not like the VTI, but the VT, which is the whole world. It's an ETF that tracks the entire world stock market. 10% in hack, which I think is a hilarious ticker symbol for cybersecurity. And then 10% in BTC, which is Bitcoin, 10% in Ethereum, 5% cash, and then 5% term deposit. Basically spread it around and use the cash when the market drops. I do like that. That in a sense is dollar cost averaging. I think personally, I do have some investment in both Bitcoin and Ethereum, but 10% on each, that's 20%, that's 1 in 5 of your dollars. I think it's a little overexposed to still a very speculative market. At the end of the day, some people swear by it and it's the future, and it maybe it will be, but 20% is still a high degree in a what can't be called anything else, but still a very young and speculative market. Okay, next one. We have a long one here, but there's one thing that I want to focus on when it comes to this one. So I would put 500K in various ETFs with different percentages. Then I would set aside 300K in a money market corporate bond ETF, which is good. Money markets are great. You can get a high return on that until 2030. And here's the thing that I have a problem with. And the rest, 1.7 million, I would put in Haro, which is basically it's a single company. It's a pharmaceutical company because I want to get rich fast. Nothing wrong with that. And I rarely see an opportunity like this that has such a large margin of safety and huge upsides. Huge upsides, maybe, but 1.7 million is way more than 50% of the total portfolio in one single pharmaceutical stock. To me, I don't really think there's any sort of margin of safety. Maybe it works out. I'm all for trying to expedite, the path to riches. But at the same time, you have to balance that with some sort of protection and diversification. Me personally, this is way too much in one single stock. Maybe one single ETF, maybe even one single pharmaceutical ETF. But even then, I think it is way too overexposed to one sector and one company. But then again, I haven't looked into the company personally, and maybe if I used some fundamental analysis, which is basically digging into their financials, balance sheet, income statement, and cash flow, maybe I would see this differently. All right, next one. Buy a nice 2-bed, 2.5 bath, and put the remaining 500 into VOO. Hey, I like VOO. But yeah, real estate is super expensive, and unfortunately in some places like California, especially by the coast, maybe that's all you get is a house and 500 in VOO. But then again, in this market, maybe you'd get some serious appreciation, especially if you're in a highly sought after area like the coast. All right, next one. 1 million in an income-oriented security treasury ladder. Interesting. 1 million in VT, 400,000 in real estate, 50,000 in a HISA, which is a high yield savings account, and 50,000 in vehicles, renovations, toys, vacations. So this is interesting. First, a treasury ladder. Basically what this is buying multiple treasury securities that basically mature in dates moving forward in time. With that said, while this is totally fine, a lot of people do this, you can basically get similar results with, I guess I don't want to say a lot less work, but a lot less work in something like SGov or any sort of bond ETF. But that's very interesting. Next would be 1 million in VT. So this is, again, this is the total world stock market. So this person is investing in the worldwide stock market. While you do get more diversification, you're also, I guess, exposed to some markets that aren't developed as much. I do like the 400,000 into real estate. That could be personal use. That could be a rental property that generates income. That could be a multifamily. That's good. 50,000 in a HISA is also good. The problem with high yield savings accounts is, as I'm sure you know, the Federal Reserve just cut interest rates. So these HISAs are going to go down over time. The interest rate is going to lower over time. So what you could do is, if you don't need the money right away, you could lock it into like a high yield CD for 12 months or longer, and that would at least lock in that rate that is going to go down over time. The next thing is 50,000 in vehicles, renovations, and toys. Look, you have so much money with 2.5 million working for you that you might as well just invest the whole thing and just live off the income, because there is going to be a return, and the safe withdrawal rate is around 3%. Roughly. So you can withdraw that, and technically your portfolio should last a bare minimum of 30 years. In reality, it's going to be indefinitely. So I would just invest the whole thing and live off the returns. All right, next one, Dominican and live with beautiful women. Can't fault you there. Next one. Well, since the average American was surveyed, it's only right to put all of it in a Bank of America savings account and collect that juicy 0.01% interest. This is very true. Bank of America and other major institutions are screwing you when it comes to interest. If you want to make interest on your emergency fund or the cash that you were holding, please just put it in a high yield savings account. I know those are going to go away, but right now they're like 30 to 40 times higher than the national average. Bank of America is making a ton of money on your money. All right, next one. 1 million in SCHD, that's a dividend play. It is a dividend ETF. 1 million in SWPPX, which is interesting. That's basically the VOO, but as a mutual fund. So for most people, without getting way too in depth, for most people, the VOO is probably comparable, and probably, not always, but probably better. 250,000 for parents, I like that. 10,000 gifts for friends and cousins, that's cool with me. And 40,000 for current car repairs, new car. And then 200,000 living as a digital nomad while forming my programming teaching business. So a couple things here. One, SWPPX, unless there's tax implications involved, VOO will probably do very similar. The $250,000 for parents. I love my parents. What I would do instead, though, is probably just invest this money, and even at 5%, even if the money is dwindled a little bit, by investing it, that's what? That's about $15,000 every single year that you can give your parents for the rest of their life. And there would still be money left at the end. I think that is an awesome alternative. Plus, you have that money sitting for emergencies. The 10K for friends and family, that's fine. 40K in car repairs, that's fine. $200,000 living as a digital nomad. Again, you have so much money with $2.5 million working for you, you might as well just invest all of it and just live off of the returns. All right, next one, buy property on the coast, put the rest 90% in VOO and 10% in a high yield savings account. The only thing is, I mean, if you're gonna buy a property on the coast, at least in the United States, I mean, I don't know how much left you're gonna have to put into VOO or HISA, but potentially maybe is out of the country. But yeah, overall, I like the makeup. I love VOO. All right, next one, 2.5 million on black. Someone said, you know what's better than 2.5 million? 5 million. But you know what's worse than 2.5 million? $0. All right, next one, 60-40 split in VT and BNDW. This is interesting. Again, VT is the world stock market, total world stock market, and BNDW is a bond play. It is really the world bond play, but it is a US-backed, US-based bond play, and retire. I'd give $500,000 to my mom. 2.5 million is a bit too much for me. Look, I love my mom. I love my mom, and I respect this. Again, my thing is just invest that money. At 10% return, that's $50,000 every single year. Even if you dwindle that account every year, you could give your mom $50,000. If you do half of that, 5% return, that is $25,000 that you can give to your mom, basically to infinity. And on top of that, for emergencies, you'd probably still have at least some, if not all, of that $500,000. So that's what I would do personally. All right, next one, 75% in VTI. This is the total US stock market. 10% in Microsoft, 6% in the Russell 2000, which is a small cap ETF, 6% in QQQM, which is basically a newer QQQ, which tracks the NASDAQ 100, and then 3% in SGov, which is what I was talking about earlier. This is a bond play. It is an income play. My only thing is, why 10% in Microsoft? Why not 10% in like the FANG stocks, right? Or VGT, something that gives you a little bit more exposure to tech instead of putting 1 in 10 of your dollars in one single company. Other than that, pretty decent. 75% in VTI, maybe 50% of that in VTI, 50% of that in VOO. Just a suggestion. With that said, this is what this person says they're doing with their $2.2 million, retired at 64 from tech, so they're doing pretty good. All right, last one, and then I will give you my answer. Last one says, I would invest half of it today probably, and then the rest over a year. So again, dollar cost averaging. I would buy mostly the Mag 7, which is the Magnificent 7, and some other AI related stocks. So the Magnificent 7 is basically FANG, so Facebook, Apple, Amazon, Netflix, and Google, and throwing on top of that, Tesla and Nvidia. The only thing that I see with this is, again, just not enough diversification. Maybe I'm a little conservative when it comes to long-term investing, but the way I see it is $2.5 million is life-changing money for most people, and it's never work again, or at least work voluntarily money. So I'd want to protect that capital as long as I possibly can. And one of the best ways to do that is diversification. All right, now let's talk about my answer. Had to change, as you can see, it was getting a little bit warm. But when it comes to my answer for the average person, I think one, it definitely depends on your age, but I'm going to talk as someone who's in their very early 30s. So if you're maybe mid 20s all the way to 40, in my opinion, your best bet is probably putting a large significant portion of that in some sort of index tracking fund. Most people are going to say the S&P 500 because the S&P 500 one gives you diversification, but it also is the top 500 largest companies. So I don't want to say it's safe because obviously when you're investing your money, nothing is truly 100% safe, but you are balancing diversification with exposure. Now, are other things like VT or VTI good? Absolutely. Could you do dividend plays like NOBL or SCHT if you want to make some income from dividends? Absolutely. But for the average person who's going to continue working, that's the other thing. If you're going to continue working, your whole goal is maximum return. It doesn't matter where it comes from, whether that's appreciation or dividends. You want maximum return so when you hit retirement, you have the most money possible. Now, if instead you don't want to work anymore, you just want to live off that $2.5 million, you have to figure out how much expenses you have on a yearly basis, and then you have to figure out the safe withdrawal rate. This is how much you can withdraw from your portfolio on a yearly basis without touching the principal. Most of these tests or these simulations are ran for 30 years, but a lot of times they can go a lot further than that. Roughly the safe withdrawal rate, depending on who you ask, is anywhere from 2.5% to 4%. It used to be 4%. Now people more safe. If you want to be more safe, it's probably closer to 3%. So when you do the math, that's 30, 60, that's $75,000 per year that you should be able to withdraw from a $2.5 million portfolio without having to do anything. And in 30 years, there is an above 95% chance that you will still have your money, or that you won't at least run out of money in those 30 years. So if it were me, I would do probably 1.5 million in VOO. I would then do about $1 million spread in real estate. I like real estate, and I think real estate has its place. I would do investment properties, either multifamily or single family. And of course, you could even go further into this. Are you going to leverage it? Are you going to not? We're going to ignore leverage here, and we're just going to focus on the capital. So about 1 million in real estate, depending on where you are, could be 2 to 4 rental income properties. I think that's your best play when it comes to this. It gives you diversification across 2 asset classes, stocks and real estate. And I know I'm probably going to get chewed out in the comments, and people are going to say, what about bonds? What about bonds? What about bonds? You're right. You could absolutely have bond diversification in there as well. And as you approach retirement, what I would do is 40, 50, 60, as I'm approaching retirement, I would just simply move some of that money out of the stock market and reallocate that into either a bond ETF or bonds or something like that to, again, protect yourself as you approach retirement. I hope this video was informative. If it was, please consider subscribing. It helps the channel tremendously. As always, my name is Derek. I got my degree in finance, so you don't have to. If you like world economics, personal finance broken down simply, you are in the right place. So I hope to see you in the next video. Until then, have a fantastic rest of your day, fantastic rest of your week, and I'll see you in the next one. Take care.